set on a specific day. We can go to a website and see how this ultimately impacts the world. And we'll save this actually for class, because I think we want to discuss this a little bit more when we're in the class setting. So we'll get to that a little bit later. But we want to see and understand how interest rates change, and then how can we relate that ultimately to stocks. So again, how can we move this thing forward? Obviously, we can use these returns to reflect risk-free values of assets, right? So the present value of a cash flow stream, using the term structure, then you would have to use individual discount rates for every single cash flow. If we said the risk-free rate was 5% over the next 7 years, it'd be 5% every year. But what if, as we went back here, we go back here and say, well, 5 years from now, the interest rate's 4.674, and then it's 4.6. It's going to be a different rate every year. So how can we ultimately use that in our decision making? Obviously, we'd have to forecast how that would flow through all of these, the life of a project, if you will. And quite frankly, we typically don't really do that, because the number we use in analyzing returns and values of assets is usually not the risk-free rate, or it's not a rate that comes from the yield curve. So again, here we have just a very basic time value question. We have what's the present value of these $5,000? We have a different interest rate every single year, so we want to then obviously calculate that. Again, if in our time value chapter, we assumed that the interest rate was the same every year. But again, since we understand that it does change from time to time, we may want to incorporate that into our analysis. One of the questions we might have is, well, how do I get these individual numbers? How are the interest rates determined? Well, the very short-term interest rates are determined by the Federal Reserve. They don't change very often, and that's really the thing in the news that they're talking about, because that's really the base rate. The Fed funds rate is the interest rate that banks borrow at when they want to or need to get funds for whatever their business activities might be. So we're going to talk about, how do we ultimately find them, or what creates interest rates? And I think in general, beyond the fact that the Fed creates these things, interest rates are determined by expectations of investors. I mean, kind of think about this the same way you think about stocks. The prices that we pay for stocks are determined by the expectations of those people who want to buy stocks. So the interest rates that we see are created by the expectations or the perceptions of those people who ultimately want to borrow money. So the shape of this curve is frequently created by expectations. What is it that people think is going to happen in the future? Now, normally we expect the yield curve to be an upward sloping curve. That is, interest rates are expected to increase over the long term rather than in the short term. Occasionally we will find those inverted yield curves, but in general, again, we would expect things to be flat to be slightly upward sloping. Again, we're talking about risk and interest rates. Well, the U.S. Treasury securities are considered risk-free. All other borrowers have some default, so most investors are going to require a higher rate of return for other assets than they are for Treasury securities. How can we forecast interest rates? Again, here's where we kind of bring into this concept the idea of the law of one price. So before we do this, before we go to the example, let's define two terms that are important for us. One is the spot rate, and the spot rate's what you find in the newspaper. Essentially, it's kind of looking up what the stock price is today. But in this case, what we're looking for is the yield for a security at a certain specific time. So if you have interest rates, if we can use this, the way we write an interest rate, it's R and then a subscript T comma N. T is the time when the security is issued, and N is the year that it matures. So R03 is the spot rate of a 3-year investment. How do we know it's the spot rate? Well, 0 says that's the price today, and of course 3 means it's a 3-year investment. But if we have something written R4 comma 7, that's a 3-year interest rate, but that's a 3-year interest rate that doesn't happen for 4 years. Again, how do I know that? T equals 4, says that's 4 years is when it's going to be issued, and then 7, the difference between that is obviously the 3-year investment window. So how does this ultimately work? These forward rates are what you expect to happen in the future. So let's think about the law of one price. The law of one price says that everything that is identical, or any two assets that are identical, should have the exact same price. So let's say we have a treasury security that we could buy and we could invest for 3 years. But there's lots of ways that you can invest in the United States government for 3 years, right? We could buy a treasury bond today and it could mature in 3 years. That would be R03. Or we could buy a treasury security for 1 year, R01, and then at the end of the first year we could then buy a 2-year one, so then it would be R13. Or we could buy a R02, a 2-year investment, reinvest that for a year, or we could buy individual 1-year investments. The key is that all of these have to have the exact same return, because they're all 3-year investments in the exact same company, in quotes. It's investing in the government, so they all have to have the same returns. The R03s then are things that we know. We understand, but we know how to calculate those numbers. Excuse me, pushed the wrong button. So let's think about this. Let's say, let me see if I can insert, I want to insert a text box. So here's text box. Let's say that this is a 6% return investment, R03. So then we go to the newspaper and we find out, because that's where we got the 6%, we find out that the 1-year interest rate, again, we find out that the 1-year interest, oops, I didn't want to put that there, I want to put that over here. Let's find the 1-year interest rate is 2%. So it's 2%. And again, we're not going to use the time value of money here, but you'll understand the process here. So if the 1 year is 2%, 3 years is 6%, then what has to be the rate of return on an R13? Well, it has to equal 6%. So this one over here has to be 4%. So now, what about R02? So let's say that R02 is, just to mix this up a little bit, that's 3.5%. So this is 3.5%. What does this one over here have to be? Well, 3.5 plus whatever that is equals 6. So again, that has to be like 1.5%. So now we can start to pull these down. We can say, okay, well, R01 is 2%. R03, we didn't insert it there, but let's go ahead. We know that this 2-3 thing here is 1.5. So I can pull that down here. So I know what? That 0-1 is 2%. 1-2, I don't know what this one is yet, but this is 2-3 is 1.5. So 2. So this year here has to equal up. 2 plus 1.5 is 3.5. So that means that the 1 year interest rate forecasted forward then is 1.5%. So how can we use this in our forecasting? Again, we had talked about a little bit earlier that we can indicate that there are different interest rates for each year. That's essentially what we've created here. This is risk-free interest each year for the next 3 years. What if this wasn't a risky asset though? Maybe we know that the risk premium, the typical risk premium on stock is 7%. So we would say that this is what? This is 9, this is 8.5, and that's 8.5. So we can adjust this forecasting for the riskiness of the investments that we're looking at. I'm going to ask you ultimately is to create a couple yield curves, and we're going to use your birthday for the past 5 years. So again, we're just going to, oops, I'm sorry, I didn't want to do that. Let me go back to this. I need to go to this particular chart. So let's go here. Let me just do this a little bit harder than I really wanted to do. Now we go up here, find this, plug it in, paste, go. Hopefully this will go pretty quickly. There we go. So now I'm at the Treasury Security. I'm at their website, and what we'd like to do is find Treasury rates. Well, this is in this case, if you look, these are the daily Treasury yield curve rates going across here as well. 1 month, 3 months, 6 months, right? And it's just for the current month. Well, we don't want that, so let's go back. Let's say we go back 5 years, 2008, right? So this takes me back. Here are the yield curves for 2008, and you want to find your birthday. So you get down here, find your birthday, and you're going to calculate that. You know, if you notice, my birthday's not here. It must be on a weekend this year. So just grab a row that's close to you, and you're going to input this into a worksheet so that you can do a graph of the, in this case, 6908, and then you'll do the exact same thing for 09, 010, etc. So we'll ultimately then be able to create a yield curve from that data. And here's what I picked for this particular year, right? Here's 6, 7, here are the 3 years, here's the yield curve, and here's what the pictures look like. So we have the dates, we know what each one of the yield curves looks like, and you can see that over time, certainly it changes, and it's not necessarily in any real order, right? They're not numerical, if you will, or chronological, right? Here's 2012, here's 13, way up here, this purple one here is 10, the green one's 11, and the one at the top is 9. So there's no real chronological order to these, but you can see that in general, over these 4 or 5 years, interest rates or the yield curve has been an upward sloping curve. What does that mean? It means that the risk-free rate of return is higher for longer rates than shorter rates, but it is an indication that possibly inflation is increasing. Again, how could we use this? We need to understand the concept of risk premium. We'll talk about that in some later chapters. But if you know what the 1 year risk-free rate is, then you should be able to then add the risk premium and then at least have an initial guess or a forecast of what the actual rate of return would be for a risky asset. Let's not forget the idea of taxes, that certainly taxes are important. And we want to be concerned about the after-tax interest rates. We want to make sure that we incorporate that in all of our thought process. And finally, what's this idea of opportunity cost? We want to, as we discuss interest rates and how you purchase things, especially from the corporate context, we want to talk about what's referred to as the cost of capital. What does it cost the company to borrow money? But they don't just borrow money, they also issue stock. So we have to have an average, if you will, of what it costs the company to use the variety of sources at their disposal. We actually have a chapter on this where we'll talk about it, which is called the cost of capital chapter. And of course, that will be a little bit later on. So that's chapter 5. As we move forward from here, we're going to move to a more practical aspect. We've started to talk about interest rates. We know at least a little bit about how they're created. We also have an indication of what the components of those interest rates are. we're going to have to now start to apply some of these basic concepts.